In this video, we're going to walk through the Agility billing methods. To understand the billing methods first, you will need to kind of understand how the configuration of the different service items are set up in the system. So if you look at the Tasks and Events tab, and then you click over on drop down, you can see currently I'm linked over to my Quickbooks account. And by linking over to Quickbooks, each one of these items that's set up as an item or service in QuickBooks has a QuickBooks rate tied to it. I can create some on the fly if I'm not listed in QuickBooks or if I'm not using QuickBooks. That will allow me to put in a name and whatever the rate I want it to be within the system. It uses this rate to determine basically the calculation off the number of hours spent on different items. And then if there's some I don't want to see that were set up in QuickBooks, I can simply turn these on and off to where they won't show in the system on the Agility side so that users won't be able to use this. In addition, we actually allow you to do some setups on individual roles. So individual role users can actually only see specific task types as well. So I could come in and say, okay, all my general users, the only thing I want them to be able to see is phone support and sales. So when they're creating their own tasks, they can only select one of those two items so that I know that they're only going to see the items and they're going to be described correctly and billed correctly at the correct rate when they're creating their tasks and activities. So we try to make it very flexible for you to kind of drill down and only let specific users under specific roles see specific items, even though we know that some QuickBooks setups are going to have a bunch and pages and pages and pages of tasks or services set up. So with that understanding that you have a QuickBooks rate or you have a rate that actually is tied to a specific task item, let's get into the billing methods. Currently we have 5 different billing methods set up in the system. Block of time with expiration, flat rate, retainer cost, and time and materials. And we're just going to walk quickly through each one of these. The block of time and block of time expiration is basically time related, strictly time related. So the example of this would be somebody might buy a 100-hour block of time, and this would be something like an IT company. So an IT company may give a reduced blended rate for any service that they do if somebody pays in advance. So let's say the blended rate is $100 an hour, meaning that if you come over here and no matter what your hourly rate is for whatever services, some are higher, some are low, but you're going to bill this particular customer out at $100 an hour because they're going to pay in advance. So they bought 100 hours at $100 an hour, so it's a $10,000 kind of like a retainer that they gave you up front. If you set any of your projects up as a block time or block of time with expiration, the billing is going to create 0 invoices. The reason for that is because we're tracking the time in Agility. So we're deducting from their block of time any of the time that has been used under this block of time, and we're just subtracting the hours. But you've already recorded the $10,000 that you've received because they've paid in advance. That's the reason you gave them the blended rate. So when it comes over to QuickBooks, you're still going to have an accounting of showing that it's a 0 invoice. And on the Agility side, you're still going to have an accounting showing that we're actually deducting hours from that user's block of time and keeping track of it. The reason we have 2 different ones is block of time and expirations. We do have some customers that have requested that when they set up their actual block of time, that for their actual block of time support, that they would want that block of time to expire after a certain time rather than just be indefinite amount of retainer hours. And so we'd have set that up for people. And we've made it kind of easy for you to actually add to these block of times because since Agility is just tracking the time, you can go ahead and do whatever accounting or whatever kind of invoicing that you wanted to do for this ahead of time. Come over to Agility, say we want to add a new block of time. They're going to buy another 100-hour block of time and they bought it at $10,000. So it allows us to track it on our side, but it automatically creates kind of a first in, first out system that now that particular company under their block of time project has 2 block of times, and it starts taking from the retainer hour and using that blended rate first. And then once that's exhausted, it comes to the second one and uses that one second. The other thing is if you're using the expiration date, once you're past the expiration date, everything reverts back to rack rate, meaning the system will deduct from the block of time using whatever that blended rate was while it's under or less than the expiration date. But if the person carries over and they don't use all their block of time and it expires and they have another service item that they need to be done, that's going to be billed at normal rack rate unless they subscribe to a new block of time. So we track that for you as well. The other one is flat rate. Flat rate is if you've predetermined a price for a service or a project within the system. So regardless of how many hours are going to be spent on the project, you basically already said we're going to do this. And an example of this, let's use something from a creative services agency. If they were building a website for somebody, and you wanted to set a number of tasks to where you're billing them at a certain interval, you can come into flat rate billing and say, okay, it's a $10,000 website, but we've got 4 tasks with the initial meeting going to be at 25%. Well, that's due when it gets closed out. When we do the wireframe, we want another 25%, 25% when at development, after we're done with development, and then the last 25 when we go live, which would equal 100% billing. So you can actually come into Agility, and when you actually create your project and you create your tasks underneath them, your task, you'll be able to actually come in and add a specific percentage of when you want that to be billed by. And then you equal it up to 100, and that's how it knows to bill once each stage is completed. And once it's completed and closed out within our system, it would, regardless of how many hours are spent on the project, it would still bill it out at 100% of whatever your flat rate billing was. Retainer costs. This is something that's become more used now in some creative agencies as well as some IT agencies as well as law firms. So this is basically, it's a predetermined price for services for your customers at a reduced rate because you're basically paying for it in advance, but you're getting reduced off of rack rate rather than just that blended rate. We see that now with inflation and with different things charging different, and you've got different services that have such a wide range within one organization that sometimes the blended rate doesn't work. So the difference between a block of time and this retainer cost is the retainer cost, instead of taking time away from the block of time, the retainer cost is taking money away from the block of money that was given. So the idea works in the same way that you take a specific amount of money out and it's for a specific dollar amount. And then with that retainer dollar amount, instead of subtracting from the amount of hours, it's subtracting from the amount of dollars. So the idea would be that if you did have under your configuration that you had set up for a specific drop-down menu, if you had a $30 or a $35 or some type of QuickBook rate set across the board, that you would set that particular company up when you select their project. And I'll do one real quick for you. If we create a new project for a company, and this is going to be some kind of programming deal we're going to do with them, and the billing method is going to be retainer cost. At that point, it's going to say what percentage of a discount are you giving off your rack rate. We're going to give a 10% discount. And what's the total cost? It's a $10,000 project. So while you're doing this entire project and any task that's billed under this project for a specific company, the way that it's going to work is it's going to, any task that's built, it's going to give that 10% off or whatever percentage off. So the billing, when it comes through, is going to be a reduced billing off of your rack rate most of the time because they are paying you in advance. So you're just going to kind of give them a discount as they go based off the amount that they paid you in advance. Time and materials, just good old time and materials for general billing of services. Time and materials, just whatever the expense is, that's what it gets added up as. We do allow something called third-party expenses in our system, and it's kind of a cool feature that we've come up with that allows you to, when you're doing time and material billing, that you can, a lot of times we've noticed that somebody will be doing time and materials, but as they're adding a task to do some work, maybe they're doing some uh, consulting, but bought stuff. They ended up having to go somewhere and purchase something to actually complete that particular item. So in this, we have this third party expense. And basically, what the third party expense allows you to do is say you spent $300 at Home Depot or whatever, you can say what it was for. You can upload the document straight from your phone, just scan it in or upload it from your phone. And then once you've attached that to it, your billing is going to be based off the hours you're actually billing when you add activity, but it's also going to create another record at that $300 for the expense amount. And then it's going to do the margin of that based off of, if you look at your company, each one of your companies, you can create a markup. And some people may have like a 30% markup for a specific company. And the reason we do it this way is this allows you to have individualized markup for each one of your companies for any third party expenses that you may incur while you're doing a project, so that time and materials allows you to do a little bit more, because you're not just time tracking, but you're also doing a little bit of material tracking to be able to recoup those costs. And a lot of times we know techs go on site and may have some additional expenses that never make their way all the way back to the back end. So this is a way to recoup and make sure that you mark up those items and get those items recorded and uploaded and the receipts uploaded all in one swoop from their mobile device.